Good morning. This is Jim Barlow with OakTree Premium Finance, and here to talk about transforming life insurance into a powerful wealth building tool. This I made this presentation a bunch of times, but I've tried to work hard to reduce it to a shorter presentation. I think I've done a pretty good job.
I don't have an answer for that. Is there something else I can help with?
Sorry. uh,
It's all good.
Boy, that I didn't know things like that happened in my office. Oh well. Okay. Anyway, I want to start with kind of a story or a discovery. Let's talk about dining out, going to dinner, restaurants. In the 50s, people rarely went to dinner, a few times a year, mostly for special occasions. In the 60s, occasionally, once or twice a month, fast food begins to grow. You start hearing and seeing McDonald's more prevalently. I grew up in the 50s and 60s, and my family, my parents, we went to dinner occasionally. Um, Probably even in the 50s, it was occasionally. And we were, my friends, none. Uh, I was the exception. They said, wow, going to dinner. Um, And it was special occasions when we went to the prominent ones that are still around in the area. But anyway, in the 70s, people started going more often, monthly to weekly, and we started to have family restaurants and casual chains started to expand. Then in the 80s, 1 to 2 times per week. Fast food and mall food courts popular. You could probably visualize this and also place yourself as we're thinking about this. Then in the 90s, 2 to 3 times per week, the 2000s, several times per week, dining became entertainment. 2010s, multiple times per week. 2020 is a little different because of COVID. More takeouts, a little different twist came about, but people are still going to restaurants. Anyway, what I'm talking about, what drives financial success? Well, how we spend our money makes a big difference. Um, and maybe you have more ATVs than going to dinner and restaurants. But anyway, what drives financial success? True financial success comes from disciplined behavior, understanding what really matters. Capital at work is three-fourths of more important than the rate of return you get on your investments. In the investment world, including myself for 35 years, I was trying to get a better return for my clients. But really, capital work is the more important thing. That means putting more money dollars to work through increased contributions, strategic leverage, or both, and far more powerful than chasing returns. Anyway, whatever you spend your money on, make sure you're putting enough capital work, or you're even using leverage to get better returns. 3 rules of financial success. Live below your means. This is a tough one. As we get raises, we like to spend it. Spend less than you earn. 2, invest enough in your future. A 401k probably isn't enough. And don't chase returns. These are my 3 rules. So let's get started with my topic. OakTree Premium Finance. We use a leveraged life insurance strategy to maximize income, transfer wealth, enhance benefits. And I believe you're going to see that this is a game changer, something that you've never probably looked at or thought about. Who am I? Well, I call myself the Alchemist. I transform life insurance into a powerful wealth building tool. I'm married to Barbara. We have 7 children, 28 grandchildren. I graduated from BYU, avid fan, investment advisor 35 years. I'm doing what I like in retirement. I love helping people, and I'm doing less. I'm not looking for the individual stocks or bonds or mutual funds, but I'm doing it within the life insurance world. Our values: we like to travel, we go to work in the temple, we read books. Anyway, I like life. There's my family, uh, 28 grandkids and 7 kids, and we've got some more weddings coming about. So those grandkids are getting married. So transforming life insurance into a powerful wealth building tool. For centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. Well, I'm going to show you how you can do that. It really can. I'm going to turn life insurance into gold. You're going to see the tools. I'll give them to you of how you can use this strategy. So, welcome to the alchemy of wealth creation. That's what we're going to be doing. We're blending life insurance, a growth strategy, and leverage into a powerful alchemized approach to exponential wealth building. We're going to cover those quickly, but one at a time. Is alchemy happening today? I'll say it is. I have a cell phone. What an alchemy that is. Internet, whatever, chat GBT. I use it. Uh, Healthcare items, whatever. There's a whole list of all the things. Um, Elon Musk, maybe he's the face of it all, but there's things happening. We're improving society. So I use a product called Kaizen, and we're going to show you all about it. But why do people use it? I put it in top tier and middle tier. Top tier, more retirement income, which is a big deal. Tax-free included and no downside. Wow, that sounds pretty cool. Middle, long-term care and disability income. This is the best way, I think, to cover those needs you have. Minimal financing, only 5 payments. You could use it for gifting, benefits, uh, legacy planning. It's used in a lot of different ways. There's some guidelines, ages, health, income requirements, commitment to the product. So let's get started with this life insurance. There's 4 major bullet points about life insurance. We've got the death benefit. You knew that was there. This protect your family in case you're not there. Number 2 is living benefits. A lot of people don't know that these are even there, but they've attached living benefits to this life insurance policy. So you can have benefits if you become terminally ill, chronic illness, critical illness, long-term care. I think this is probably the number one reason a young person should purchase a Kaizen, so that they get these living benefits so they never use a, well, never mind, we'll go on that later. Tax advantages. Life insurance is tax-free to the beneficiaries, and it grows tax deferred, and you can borrow from it. So we can, by using strategy, and we can make this a tax-free retirement account. That's a big deal too. Then there's no investment fee, advisory fees, zero, very little or almost none management fees. So your fees are low except for life insurance costs. Is tax-free, the living benefits. this is an interesting tool that we would like to be able to expand it, in which we have. Above all, this protection is protection for your family's lifestyle, for your long-term care, disability needs. It's about making sure that your loved one and yourself is secure. I never want one of my clients to end up relying on a GoFundMe. That means they didn't have the coverage to protect themselves, and they can today. So I'm going to put up this slide as we finish this section, and you'll see there's a lot of white space because I'm going to add those next two. But there's the I put in yellow the benefits of life insurance: reduce financial and vulnerability risk, reduce tax risk, reduce fee-related cost. Any questions, anyone? I'm not seeing any. All right, let's keep going. I want to do a hypothetical so that you can see kind of the numbers. I'm going to use a 45-year-old. The average Kaizen purchase is 47. Male, excellent health, non-smoker, 240,000 income. He has some savings towards retirement, and he's willing to put 50,000 a year for 5 years, the Kaizen plan. And he'd like to see what kind of retirement he can get from this. We're going to show begin a distribution at age 65 all the way to 100. Here's the assumptions I'm using: 6.65 return. This is because it's regulated by the NAIC, National Association of Insurance Commissioners, and that's the current rate allowed on May 8th. I think it's, I checked 2 days ago, it's the same, it hasn't changed. There's the income tax, capital gains. I'm going to use all the different tax we pay in society to have a good comparison. And let's get started. So if you got that 6.65 and you paid taxes as you went, you could have an income from this 50,000 for 5 years, starting at age 65, of 35,585. And by the time you hit 100, you pulled out 1,281,000. Not bad. It shows you that putting money aside works. Tax deferred, if you do an IRA or 401k, you could be pulling out 45,000 at 65. And that blank spot down below, we're going to fill in the blanks with the Kaizen and show you how it compares as you learn a little bit more. So now we're into the growth strategy. We use a kind of policy called Index Universal Life. Came about in 1997, not that many years ago. The main features is you have growth with protection. You get market-like returns with zero downside. In the negative years in the market, when it's whatever the negative is, you get zero. That's good. I like that. For retirement and something you got to have, this is good to have. Turnkey. Once you purchase it, the management is going to be very minimal. Annual decisions, hardly even that. But it's just not going to be a major concern, whatever the economy is doing. You have indexed options. I'm going to explain this a little bit about, but there's two types of indexes. There's capped and there's participating indexed. Capped means after a certain percent, you don't get any more. If it's capped at 12, then if your market does 13, you don't get the extra one. Participation rate means you get a portion of the index, even beyond 100%. sometimes over 200% of the participation rate. So the performance side is really exciting. There's index lock. There's a bunch of things that I kind of cut out talking about, but I want to show you how they guarantee no risk. So beyond the insurance costs, let's say a person puts in $1,000 in a 5% interest economy, 952 would go to the general fund of the insurance company, their big portfolio of bonds. And that bond portfolio in this 5% market, they know will grow to $1,000 1 year later. And so they take the difference, $48, and put it into buying options to try to replicate the market. And if that options expire worthless, you still have your $1,000. You can't lose. The way they structure it, you literally can't lose. If you have a higher interest rate economy, you'd have more money for options, and you could buy more of the market, more participation rate, higher caps. But the main thing is you're always zero risk. Can't lose money. So I've gone through that pretty quick, but no downside. Reduce investment risk, reduce liquidity and accessibility risk. You don't have RMD, require minimum distributions. You don't have 50.5-year rule with your pension money. This is the growth part. Let me check. Let's see if there's any questions. Well, not today. That's okay. I don't mind. Maybe next month or next week. Okay, we've covered life insurance and growth. And now last, we add leverage. Let me talk about mortgages for a second. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. Well, I wasn't around, so I didn't experience that. I only know about the 30-year loan. The FHA came about, and Federal Housing Association 30-year loan came in 1934. Before 1934, 40% were able to buy a home. Today, 66%. In some countries of the world, it's even higher. There's a lot of money in mortgages. Is this good for a family? Is this good for society? Absolutely. More people have homes because they found a way that they could use leverage to do so. What are other ways we use leverage? Obviously, homes, cars, everyday essentials, education, healthcare, medical needs, major life events, starting a business, real estate investments. The wealthy, they really know how to use leverage. That's the wealthy get wealthier because of real estate and leverage, starting their business and these different things. So here's Barbara and I. This is down in Cabo. We hired a photographer to take us around to different places and take our picture. And we do a vacation a lot. We go a lot of places. Last month we were in China, major, wonderful trip. Next month we're going to the Bahamas, taking some grandkids. Anyway, my question is, why are we using leverage for retirement? Generally, we just don't. Well, Kaizen allows you to do that. So what we do, here's the banking part, the leverage. We're going to borrow 3-to-1. And it's just 5 annual payments or 60 monthly payments with all-in-ones. And we pull all this off with I'm getting ahead of myself. We do it in a trust ownership. And there's a lot of different features and riders we add, but I don't want to explain it all. Can do individually, but these are the main bullet points on this leverage in banking. And here's the Kaizen approach. We have 5 annual payments or monthly payments for 5 years. We get a bank to put in approximately the same amount you're putting in for 5 years. Then the bank continues to make the payments they're making, and they pay what you are paying for the next 5 years. So there's payments, money going in for 10 years, but you're only half of it in the first 5 years. That's approximately the 3-to-1 leverage. All without typical risk of borrowing. There's no credit checks. There's no loan documents. There's no personal guarantees. There's no signature on a loan. There's no collateral. That's because of the way we structured it and build it. The bankers say the policy's adequate. We don't need any side loan agreement. Here's how it's worked. The very first policy issued was in 2012. And every year we come out with a statement, an annual statement. And last June statement, hey, we're going to be getting a new one for this first policy soon. It had averaged 7.73% return per year from 2012. And it had averaged interest rates that paying of 3.81. So there's that a fourth of the money you're making 7.73, and the 3/4 of borrowed money you're making 3.92 for the last since on the first policy, 3.92% on borrowed money. Wow. We back tested this strategy. We went back to all the way to 1930, and there's never been a 15-year period of time with less than a 2% spread. So can we guarantee a 3.92? No, can't guarantee it or a 2, but we can tell you there's never been a 15-year period of time with a 2%, less than 2% spread. You're going to get 2 to up to 4 on borrowed money. And I mentioned a trust. We set up a trust, and we set up individual trusts for you, but the master trust is the one who's making the loan, and they're not requiring the individual owners to collateral or anything. But the trust part is one of the reasons it works. Now, remember those hypothetical numbers a little earlier? Well, we're ready to show you how Kaizen performs. I did a drum roll, please. What do you think? Think it'll be 45, 35, 45, maybe 55, maybe 60. Well, let's do the drum roll, please. I guess I should get some sound. The Kaizen would give you 89,000. And by the time you hit 100, you have pulled out 3,204,000. And when you bought it at 45, you had 1,384,000 death benefit, and you had the living benefits associated. And even at 100, you still have a death benefit for the third generation of $1 million. Well, maybe not the third generation, certainly for the second generation of $1.3 million. So that's better than a tax deferred, a whole lot better and safer. We did some studies. They do this continually, evaluating, make sure it's correct. We wanted to stress test Kaizen to see how it did or would have done in the two worst scenarios we've experienced: a depression of the 30s or high interest rates of the 1980s. The depression was, well, I wasn't there. You weren't there. None of us were there. My parents were there. But from 30 to 32, the stock portfolio lost 70% and did not recover until 1959. Oof. The Great Depression similarly has 9 years of zeros, not negative, over 12 years. And the 1980s, interest rates got as high as 16.88%. Anyway, we want to stress test and give you the numbers of how they would have done in those years. On the 1980s stress test, 66,000. It is about almost 10,000 over the, oh, I added the index universal life here. This is without the leverage, the index universal life, 58. And the stress test in the Great Depression, 57,000. Still good. And you didn't destroy your retirement. And I went a step further. There's actually a study done that 80% of the time these numbers are wrong and you're going to get a double. So I put down this 178,000, a double of the 89,000. That's an 80% chance that that's going to happen. Wow. So that completes all three sections. So with the leverage, substantially reduced capital outlay risk because you've got more working for you. Reduced payment fatigue, only 5 payments. Reduced liability risk, there's no loan. Reduced management and complexity risk, very turnkey, as we said before. There's all the benefits. They're all great. Any questions? Let's see. Okay. All right, let's keep going. We're getting close to closing, but I found this 7-point risk matrix. And I'm being a little tricky here, but risk-free is FDIC insured savings. This is in the bank. 2, low risk is government bonds guaranteed by the federal government. And then I put high risk, private equity, speculative real estate, extreme at risk, crypto, options trading, startups. And in the middle, 3, 4, 5 is these other risks. And where does Kaizen fit? Well, here it is. It's really just a notch above government bonds. Moderate to low risk, in the same category of high quality corporate bonds and annuities, but a whole lot better return. Excuse me. We recently created a new landing page that goes over Kaizen extremely well. You've got the video, you've got a calculator to calculate potential returns. You've got an explanation on everything. They've actually broke it down into chapters. I think, but before I move my slide, that QR code will bring you to this landing page, and you can explore Kaizen to your heart's content. When if you're ready to move forward, you can. My number is on that page. My email address. Also, we have you can just keep moving forward and go to a more advanced site. But anyway, happy to help. I think spend all the time you need here. I think you'll love it. This is part of it. Another video they have. Oh, I'm sorry. I'm spaced it out. This one here is about retirement. They just recently created a new one with for gifting to your kids, and it's another landing page like that one, but it has the emphasis of people considering it as a gift, and they really they've been working really hard on this. And actually, my next week's presentation is not this one, but it's going to be all about this gifting strategy. I haven't made a QR code on this yet, but if you're interested, just text me, email me, and I'll send you a link so you can do the same education. I have a great website. I think it's phenomenal, but of course I'm the fathead here. I've got lots of links on my website. I've got a calculator that's pretty cool. And that's it, 11:31. I've pulled it off to get this close to a half hour. And there's the QR code, and so that you can learn more about Kaizen. We haven't had hopefully it's not so complex that no one's wanted to ask questions, but I'm sure there will be other weeks. But that's it for today. There's my phone number, my email, my website, and the QR code so you can start to learn about Kaizen. And there I am. I'm the Alchemist. Have a great day.